In the decade following the First World War, the world was dancing. It was an era defined by a profound sense of optimism, cultural rebellion, and dizzying technological change. From flapper dresses and jazz music to the widespread adoption of radios and automobiles, the 1920s were a time of boundless prosperity. The stock market, once an exclusive playground for the wealthy, was now a source of fascination for everyone. It seemed like you couldn't lose. The market was a one-way ticket to prosperity. But beneath the glittering surface of this vibrant party, a dangerous game was being played, a game of speculation that would eventually bring the entire world to its knees. Welcome to Economic Epochs. Today, we're journeying back to the Jazz Age to explore the story of the Roaring Twenties and the catastrophic financial earthquake that was the Great Depression. We'll peel back the layers of a time when the American dream seemed within reach for anyone, and discover what happens when a nation's confidence becomes the biggest bubble of all. Our story begins in a period of intense economic expansion. The American economy, fueled by mass production and consumer credit, was booming. Henry Ford's assembly line made the automobile accessible to millions, and a flurry of new electrical appliances, from washing machines to vacuum cleaners, changed domestic life forever. This new era of consumerism was powered by advertising and the revolutionary concept of buying now and paying later. People were encouraged to live beyond their means, all in the name of progress. This newfound prosperity didn't just stay in people's homes, it flowed directly into the stock market. Once the exclusive playground for the wealthy elite, Wall Street now captured the attention of the middle class. Everyone, from factory workers to shoe shiners, wanted a piece of the action. Stories of ordinary people making a fortune overnight were commonplace, and they were a powerful motivator. The market seemed like a one-way ticket to prosperity, and the motto of the day was simple: you can't lose. The main engine of this speculative frenzy was a risky practice known as buying on margin. This allowed an investor to buy a stock by paying only a fraction of its price, sometimes as little as 10%, and borrowing the rest from their broker. For every $100 you put down, you could control $1,000 worth of stock. As long as prices kept rising, it was a fantastic way to multiply your gains. But if prices fell, even a little, the consequences would be dire. The brokers could call in the loans, demanding immediate repayment. If the investor couldn't pay, they would be forced to sell their shares at a loss, creating a domino effect that would send prices spiraling downwards. The market became completely detached from the fundamental health of the companies. People were pouring money into anything, regardless of its true value. New financial instruments, like investment trusts, sprung up, selling shares in a basket of stocks, promising diversification but often just adding another layer of risk. There were no meaningful government regulations to protect investors, and insider trading was rampant. The prevailing belief, parroted by everyone from financial journalists to university professors, was that the market had entered a new era of permanent prosperity, and a crash was simply impossible. As the 1920s roared on, the market's ascent became almost vertical. From 1925 to its peak in September 1929, the Dow Jones Industrial Average soared from 180 points to a record high of nearly 381. There were countless warning signs, but they were all brushed aside. The Federal Reserve, worried about the rampant speculation, raised interest rates in a futile attempt to cool things down. Seasoned economists and financial experts like Roger Babson publicly warned of a potential crash, but they were dismissed as relics of the old economy, their cautions drowned out by the euphoric chorus of the market's believers. Even the most cautious investors were tempted to join the party, afraid of being left behind while their friends and neighbors got rich. The euphoria was captured in phrases like "everyone ought to be rich," which was the title of a popular book by financier John J. Raskob. This sentiment, that the market was an infallible path to wealth, became an unquestioned article of faith. Banks were lending money to brokers, who were lending it to investors, creating an immense, fragile pyramid of debt. The music was getting louder, the dance floor more crowded and unstable, but no one wanted to stop. No one wanted to be the first to leave the party. The first crack in this beautiful facade appeared on Thursday, October 24, 1929, now famously known as Black Thursday. The market, which had already been wobbling for a few weeks, began to fall, and panic set in. Thousands of investors, spooked by the downturn, rushed to sell their shares. The supply of stocks on the market overwhelmed the demand, causing prices to plummet further. The ticker tape, the machine that printed out stock prices in real time, couldn't keep up with the volume of trades, leaving investors in the dark about how much they were losing. Before we dive into the catastrophic end of this era, if you're finding this history lesson valuable, please take a moment to hit the subscribe button. It's a small action that helps us continue to bring these powerful stories to life. In a desperate attempt to stop the hemorrhaging, a group of leading bankers, led by the head of the New York Stock Exchange, Thomas Lamont, attempted to prop up the market. They pooled their own resources and, in a dramatic gesture, began buying large blocks of stock above market value. For a fleeting moment, it seemed to have worked. The market stabilized and even rebounded slightly on Friday. The headlines the next day declared the crisis averted. But it was a temporary fix. The weekend only gave investors more time to reflect and realize the gravity of the situation. The true panic hit on Tuesday, October 29th, Black Tuesday. The floodgates opened. Over 16 million shares were traded that day, a new, horrifying record. Prices fell uncontrollably as sell orders came in from every corner of the country. The floor of the New York Stock Exchange descended into chaos. The nation's financial pillars were crumbling. By the end of the day, a staggering $14 billion had been wiped out, a sum that in today's money would be in the hundreds of billions. The Great Crash was not a single event, it was the trigger for a devastating, decade-long cascade. The buying on margin loans were called in, forcing millions of panicked investors to sell whatever they had, pushing prices down even more. Businesses, facing a collapse in consumer confidence and a freeze in credit, began to close their doors. Bankruptcies soared, not just for individuals but for businesses that had invested their capital in the market. As banks failed, depositors lost their life savings, as there was no government-backed insurance. A vicious cycle was born. The loss of wealth led to a collapse in spending, which led to business closures, which led to mass unemployment. The crash was the trigger that plunged the world into the economic catastrophe we now know as the Great Depression. The social consequences were as brutal as the financial ones. The confidence that had defined the 1920s evaporated overnight, replaced by widespread fear and despair. Millions lost their homes and jobs, and lines for bread and soup kitchens became a common sight in every American city. The optimism that fueled the Roaring Twenties had been replaced by a gnawing despair that would define a generation. The Great Crash of 1929 is more than just a date in a history book, it's a profound lesson in the danger of a market fueled by speculation and greed, rather than real value. It showed us what happens when a whole society decides that the laws of economics no longer apply to them. And it set in motion a series of fundamental changes, including the creation of the Securities and Exchange Commission, SEC, designed to regulate the stock market and prevent such a disaster from happening again.